Once again, you are welcome to the next segment. So it's better it's short like this so that we can the video that we are recording can also be a bit easy to send. Yeah, so this is the second segment of the financial accounting class, and this segment we are going to continue from still the concept of double entering and the principle of decile and cadile, but in this case we are going to look at it from a concept entirely different known as control accounts. You get? The control account is still based on the concept of decile and cadile. Okay, Monarchy, speak. Hello, can you speak? Okay, you are muted again. I have unmuted you before. Yeah, Monarchy, speak.
Speak now.
Hello, can you say something? Okay, Monarchy is not talking. Okay, just mute. I'm not hearing you. Okay, so let's proceed. So I said where we stopped was the double entry concept, which I've told you that is just a concept that explains for every debit entry there must be a corresponding credit entry. And the concept of decile. The way I gave you that decile, just memorize it that way. You can't hear me? Okay, wait, let me check. Okay, sorry. But you can hear me now. Can you hear me now? Yes, okay, thank you. So let me mute all. Okay, let's proceed. So control account is another dimension that also tests your knowledge on the principle of decile and what? Cadile. Now, when you say what control account is, please take note. The word control. You know, when you say I control the person, you understand? But in accounting, you are not controlling person. You are controlling figures. You know why you control figures? So that it can be easily understood and you can minimize errors. Are you there? Because if you don't control figures in an accounting form, you can encounter what they call there will be too much of figures, such that you will not be able to detect where errors is coming from. And it's applicable. These things are very real. You understand? So the only way we can actually minimize error is to use what they call control account. So the essence of control account is a kind of special account that is used to what? To detect and minimize what? Errors. Are you there? But for the purpose of this class, we are going to focus on two kinds of control accounts. So we are going to also be fast so that in less than 45 minutes, we are out of this second segment. So the two types of control accounts are, one, the trade receivables control accounts, and the what? And the trade payable what? Control accounts. If you notice, I put it in the form of what? A ledger. Can you see that there? So whenever you put a control account in the form of ledger, always know that you are going to put a debit and a credit, because control account is a special kind of ledger. Are you there? It's a ledger that has both debit side and what? Credit side. Are we together in this? Good. Now, based on this control account, the first thing I want you to understand is this: that when you see the word trade receivable is a current asset. Are you there? When you see the word trade payable is a current liabilities. So what did I tell you when you say assets? Whenever asset increases, what do? You debit it. You can check it on your decile principle. Whenever assets reduces, what do? You credit it. Am I making sense there? So it means that this trade receivable will have a a nominal, they call it nominal, a nominal debit balance, like you call it balance brought forward. Why? Hello, that can be an OBJ question. Why would trade receivable has a nominal debit balance? Because it's a what? It's a current asset. Are you there? Any asset, whether current asset or non-current asset, they have a nominal debit balance. Am I making sense there? So please take note of that. Now, it means therefore that since payable is a liabilities, the nominal balance it will be what? Credit balance. Are you there? Why? Because all liabilities should be credited when they are what? Increasing. When they are increasing. And when they are reducing, what do? Debit it. So if you say, this thing is confusing, don't let it confuse. Just check your DCIL principle. It's there. Check. When it's reducing, liability is debited when it's reducing. Liability is credited when it's what? Increasing. So see what you do. You come and say, balance brought forward, credit it. Are you there? So you understand the rules that guide us in this balance brought forward, debit and the credit side, isn't it? Good. But please take note, for the purpose of exam, there are incidents whereby they can still give you a balance brought forward to be on the credit side here. Are you there? Please. But I want to use this to ask you a question. Now, what does it mean to say balance brought forward? Balance. Okay, as the balance brought forward. It's the difference, but you are giving us the process. What I'm asking you is, when you say balance brought forward, what does it mean? From the previous close of the book that you are bringing forward. Okay, good. What about balance brought down? So, would there be a difference between balance brought forward and balance brought down? Yes. I'm asking you. There will be a difference. What's not the difference? What would be the name of that difference? Opening stock. I like this, people. Okay, now let me explain. See, you know, she was saying something about the difference between these two sides will be your balance brought down. It is that brought down, that becomes brought forward. You don't understand? You get the point? See, this is where your balance brought down will be. In this account, in your payable account, your balance brought down will be here, excess. In the next period, this balance brought down will not be the balance brought forward. Are you so good? So,
like your closing stock and your opening stock. Right?
No, don't call it stock. Don't call it stock, because if you call it stock in accounting, if maybe we are doing economics and other course, and it's called it stock, I will follow you. But in accounting, stock might be another thing. You just say your opening balance and your closing balance. You get it? So this, by the time, for those people that are fresh, especially those people that have not attended those before, that are now started now. By the time we solve a question on this, you understand when I say balance brought down. The difference between these two sides makes up your balance brought down. So when you are not opening another year, that balance brought down will not be your balance brought forward. Am I making sense there? So this balance brought forward is from last year's balance brought down. The figures will be the same, but the name might not be the same, which is one is balance brought down, the other one is balance brought forward. Am I making sense there? Now, in another case, I told you I want to ask a question now. I said sometimes, the nominal balance of a payable account is in the credit side. But I now said that there are instances whereby your examiner will give you the one on the debit side and this one on the credit side. They will tell you, they will be specific. Now, I want to ask you, what is the implication? Because one thing about book, you understand book when you understand the implication of that thing. And you'll be able to now understand why this thing happens. What is the implication of having a balance brought forward on the debit side of a payable account and on the credit side of a receivable account?
When you have your receivable on the credit side, that means your assets are reducing.
Okay. Now let me just quickly answer the question, because that question, even as I asked the question, I was not thinking about the best way to answer it. So let me just go ahead and answer it. Now, you know that when you close a ledger, you have a closing balance, which is the balance brought down. Are you there? Which is the balance brought down. But maybe after the close of that ledger, a debtor now paid. Am I making sense? And when the debtor paid, it has reduced the debtor's liability to the business. That payment the debtor made at the close of that ledger, you did not account for it, but you need to account for it in this new ledger. You can call it the balance brought forward. So it will not be on this debtor's ledger. Am I making sense there? But it will come as what? Balance brought forward on the credit side. Showing that that's your old or existing debtor that is here. Paid. But as at the time he paid, we have closed this book. Are you there? So you bring it here. Now, some people will not argue, say, Stanley, since he paid and we have closed the book for that year, why not just call it cash received from debtor? You can't call it cash received from debtor. You know why? Because the accountant will audit all the cash received from debtor for that period that you are bringing in here. And when they audit it, they will not see that guy's own, because that guy's own is reflecting in the previous year's date. So rather than call it cash, you just say balance brought forward, just put it here. You understand? So those are the reasons why you see this on the credit side. So for the payable, for example, you know payable is a liability. And whenever payable appears on the debit side, I want to ask a question now. Whenever payable appears on the debit side, what does it mean? It reduces. It reduces. You get? If your payable account is on debit, it means that it has reduced. If your payable account is on credit, it means that it has what? Increased. That's the seal principle. Now, what it means therefore that? It means therefore that the guy, part of the goods he purchased on credit before, as at the close of the period, he never knew he will have excess cash. He just quickly paid the supplier. And when he paid the supplier, they've already closed their books as at the time he paid the supplier. So for them to capture that payment, he will now bring it as your balance brought forward in the next year when they are opening another control account. So those are the reasons why sometimes you have balance brought forward and balance brought forward in both sides of the control account. Am I making sense there? Good. Now, since we already know that payables are who are payables? Payables. Who are payables? Creditors, supplier. You get? Who are receivables? Debtors. Are you there? Good. Now,
So is it safe to say that the trade receivable contract account is being prepared by business?
yes, it's prepared by.
Customers.
Yes. It's a picture of the business to the customer. Every business activity with the business and the customer is receivables.
While the other one is business and
Credit suppliers, thank you. You get? So that's why I said these three human beings I drew earlier are the people about financial accounting. You are the business. You have two parties, customers and suppliers. So receivable is looking at the business with the customer. Payable is looking at the business with the supplier. So now let me ask you, items that should be debited or credited on this account are, for example, you have cash received from debtors. Which side will you put it? Is it payable or receivable? Let me say it again. Cash received from debtors. Yes. Which account? Receivable. Which side will it fall in receivable?
Debit side.
Debit side. Why?
Because it's increasing your cash.
is increasing cash. Don't forget I say cash received from debtors.
So income as increase.
Is reducing debtors' accounts. Now let's take it again. The point he made now, we need to understand it very well. Now, how do I mean? Debtors are people you sold to on credit. They make up your what? Debtors. That is the essence of this ledger. Anything that reduces that your debtors' value will be on the credit side. Anything that increases the amount of your debtors will be on the what? Debit side. So let me say that word again. Cash received from debtor. Is it reducing the value or increasing the debtor's value? It's reducing it. So it will be on the what? Credit side. So you come and say cash what? Received. Are you there?
So it is reducing the.
It's reducing the debtors.
Debtors
Thank you. To the cost of the business. Sorry. So now let me give you another one. Yes. So the business, yes. If you receive cash from your debtor, it's reducing your debtor's liability to you. Now, what about bill receivables? Okay, to DC principle. And so DC principle is simple. Don't forget, see, DE and Abi, you are debiting expense and assets. When is what? Increasing. Car deal. You are crediting expense and assets. Don't forget, this is assets. This is assets. When they are what? Reducing. Now see, receivable account is an asset account. We agree, isn't it? What will make it reduce? If you receive cash from debtors, it will reduce the debtors accounts, which it will reduce this thing you call current assets. By so doing, you put it on the what? Credit side. So the idea is something is reducing debtor.
But it's including the income of the.
No, don't think about that part. Hello, don't over the relationship is just business and customer. Are you there? So as such, anything that will reduce your debtors, I am owing you, for example, and I paid you. Am I still owing you that money? No, I don't need to know whether the money has increased your cash. That one is not my business. The point is that the debtor and creditor relationship has been there, and I've paid you, and that's all. You get it? So now let's see another example again. It will guide us. So let's say check or bill, receivables. Check or bill, receivables. If I want to now emphasize, I can say receivables and honored. They can be receivables and dishonored. Are you there? So if I didn't put receivables and honored, what it means is that it was honored. Am I making sense there? Good. Now, bill are like check. So if your customer that is owing you give you a bill, that amount, is it still owing you? It's not owing you again. So is it increasing your debt to him, or is it reducing your debt? It's reducing it because you have paid him. Are you me? You get there. Don't worry, you just be processing it. You get it. I'll still be using more examples. So it means therefore that this is my debtor. Please, sometimes remove this receivable. Receivable can be confusing sometimes. Just remove receivable. I'll use debtor. Are you there? So this is my debtor. Anytime debtor increase, you debit it. Anytime anything that reduces debtor, you what? You credit it. So debtor gave me a bill. Is it not reducing his debt to me? He's going to reduce it. So you come and say, bill what? Receivable. Are you there? Now, what if this debtor you sold goods to worth 50,000? He now returned part of the goods to you worth 10,000. Has he increased or reduced his liability to you? It has reduced it. You sold goods to him on credit to worth 50,000. You know, say, you not to, oh God, don't forget, I sold goods to you worth 50,000. You are owing me 50,000. That the business is telling the customer now, you are owing me 50,000. The customer, I know, I will pay you now. Then the customer now return goods worth 10,000. You know, say, oh God, see, I've returned this goods. I'm not owing you 50,000 again. Oh. Don't forget, you have already put here as 50,000 that is owing you. I'm not owing you 50,000 again. Oh. What I'm owing you now is what? So return inward. Is it reducing or increasing? It's reducing. Am I making sense? So you come and say return what? You get the concept? Now, you know, the guy gave this guy a bill before. The debtor gave the business a bill. The business has already assumed that he has paid him. But that bill has not been taken to the bank for honor. The cashier of the business now carried the bill and went to the bank. And when they got to the bank, they asked, this man did not sign well, oh. Madam, we cannot honor this bill. Therefore, your bill has been what? Dishonored. What will you do? Layman. I want you to answer me. Layman. Don't think of what will you do. Don't forget, when you receive the bill, he reduces his debt. When you now go to the bank to collect the money now, they now dishonor this. What will you do? You take it back. Oga, you have not paid me. Are you there? Bill what? Dishonored. You tell Oga, you have not paid me. You put it back. What if, for example, you sold goods to customers on credits? Where will you put it? You sold goods to customer on credits. It is increasing the debtors. It is increasing debtors. You get it? Sales on credits, debtors increases. Purchase on credits, payables or creditors. So you have sold to customer and you sold to them on credits. It means that, let's assume I sold to only her on credits. The next day I sold to her again. I sold to her. How many debtors do I now have? 3. Has it not increased my debtors? So sales on credit increases what? Debtors. So we'll come here and say credit what? Credit sales. So these are items that you will see when you are dealing with control accounts. Are you there? Now, if they say cash sales, yes. Okay, what is it? Cash sales. They are not recorded. Why? Cash sales. Think about it well. Cash sales. I want us to think, because one of the advantages this class now, I don't want to be answering more of the question. Yeah, Linus, I'll call you now. I want us to think. Cash sales. Yeah, let me ask, maybe Linus wants to answer me. Okay, Linus, speak.
I wanted to know cash sales. You don't have it.
Okay, thank you. Linus has given us a good answer. Linus, thank you. He said cash sales does not have an effect on the trade debtors control accounts. Do you know why? Because nobody is owing you. I sold goods on cash. Yes, the class is recorded, don't worry. I sold goods on what? On cash. And as such, I'm not owing you, you are not, so I don't need to bring it here. The only item that comes here are any item on credits. So take note, every invoice comes to your control account. You know why? Because they are all on what? Credit. Whether credit sales or what? Credit purchase. But cash does not come. Okay. So let's see another item. Now, there's still discounts allowed. So if, for example, the business have decided to allow discounts to their customer, say, for example, you are owing me 20,000, and I say, madam, if you pay me this 20,000 in a month's time, I'll give you a discount of 10%. 10% of 20,000 is 2,000. 2,000 minus 20,000 is what? 18,000. So it means therefore you are paying him what? 18,000. Has it increased or reduced your liability to the business? It has reduced it. So it therefore means that discount allowed will be what? Credited. Thank you. Are you there? Now there's still another special item again. They call it bad debts. So this is how bad debt works. You know, there's a component of debtors that are here in this balance brought forward. Are you there? But do not discover, due to the jabarization that has been happening in Nigeria now, two of these debtors that owe you 10,000. When you chatted them, they didn't reply. You chatted, they didn't reply. Then you now come to realize that, oh, these people have what? Have gone abroad. They have jacked back. So how would you collect your money? They didn't contact you, they didn't communicate you, their line has not been going. So what would you do? Okay, no problem. These debts are bad. Let me write them off against my operating profits. When you write off debt, you write it against profits. Please take notes. Bad debts are written against profits. So they don't say that I write off debt, I write off debt, I write off. Your debt that you wrote off is reducing your income. That's why bad debt is also an expenses. When we get to income statements, you start. So it's good you start cleaning up your mind now into all these things. So in that case, if I have a bad debt that I've written off, has it increased or reduced it? It has what? Reduced my debtors. So I'll come and say bad debts written what? Written off. You get it? So lastly, there's still this concept called transfer, and there's another concept called set off. Good. You get, these are two concepts. Now please take note. Transfer means that you are taking from one debit balance and you are transferring it to another account. So if I'm transferring now, for example, between these two accounts, I'm transferring a debit balance here into this side of the debit side. Are you there? If I'm transferring credit balance here, I'm transferring credit balance here into the credit side. So most often the time, please take note, transfer increases the trade receivable. Just note that concept. So anytime you see transfer in any work, don't overthink. Just know that transfer increases the receivable or the what? Or the payable accounts. Are you there? So I can just come here and say transfer. Then, okay, when I get here, I will also do that one. You get? Then another part again is set off. So set off is that, see how set off work. It's just like I'm owing you 10,000 and I came to buy something from you worth 10,000. Then when I finish buying it, you now say, where's my money now? You now say, you forgot that you are owing me that 10,000. Right, so let's picture this now. I want us to picture it now. Dove is a business and I'm currently owing you 20,000 or 15,000. And you came to class and we said, teacher, when you want to leave now, you met first, you say, madam, you've not paid. You say, ask Stanley. Stanley is owing me 15,000. So what have you done? You have set off. Now, setting off automatically is reducing the debtor's accounts. And it's also reducing the creditor's accounts. Are you there? Please take note so that I don't overthink it. Because some of these things in financial accounting that you need to pass this course, is not overthink. Cram some of the things. Are you there? That's the idea. Cram it. Note, set off does what? Reduces the two accounts. So by the time you set off, you now come and close your account. So balance carry down. I believe you know what balance carry down is. Okay, we just have 10 minutes on this part. The difference between what? The two sides. Then this balance carried down is what you will bring here as what? Balance brought down. Then sometimes it might be balance carried down here. Is what you also bring here as balance brought down. So please take note. Whenever you have balance carried down, the corresponding side is balance brought down. So if there's balance carried down here, up here, this balance carried down here will go to this other side as balance brought down. If there's balance carried down here, this balance carried down will come to this other side as what? As balance brought down. Okay, so this is what we need to know under trade receivable control account. So with this knowledge, I will just quickly do this in another 5 minutes so that you will know that by the time this session goes off, we will now repeat the section that we used to solve questions on the two topics that we have actually dealt with now. Okay, so quick one for the trade payable. Credit purchase. Where would credit purchase be? Is it increasing? Is it increasing liabilities? Abi? Good. So I'll come here and say credit purchase. Are you there? Now, what about cash payments? Cash payments to your supplier is reducing now. You get, so always look at the word. Is it that the word is increasing or reducing? Am I making sense there? That word must, you will see it from, is it that it's increasing or is reducing? So you are looking at the business with the supplier now. So cash payments, the business paid cash to the supplier. Is it not reducing the business liability with the supplier? So you come here and say cash paid. Return outward. Don't forget, return outward is between the business and the what? Supplier. And it's not reducing. Good. Bill. Okay. Discounts received. Discounts received is reducing, Abi. Bill payable. Bill payable. You are paying to a supplier, but supplier has not gone to cash it. That's why it's called bill payable. So it's also reducing. So other items like set off reduces. Transfer will also what? Transfer will increase. Are you there? So if, for example, they say bill payable dishonored. Bill payable dishonored. You pay, it was payable before, it has reduced. Now they not dishonored it. It will increase. Yes. So these are just the whole concept. Then you can close your account. You can close your account. Here you call your balance carried down. That balance carried down will come here as balance brought down. Then here can also be balance carried down, which will come here as balance brought down.
Bad debt is also increasing.
No, bad debt is not. Bad debt is only between the business and the customer. Are you there? So bad debt does not come to payable accounts. You get? So please take note. Bad debt is between the business and the customer, not payable accounts. So you must also understand the items and where they should go. Are we together in this? Okay. So that is all for control accounts. And we'll now look at question now on control accounts. Then we'll look at, when we finish the question on control accounts, we'll quickly run to depreciation. Then when we finish depreciation, we'll go to OBJ questions. If it's 10 OBJ questions, but every time we meet, we must just be treating OBJ question. Okay, so if it's just 10, we can just do today. We'll just do the 10. So we know that we'll solve like 2 or 3 questions, then we'll call it a day. Okay, so please, my also advice for you guys is don't put pressure on yourself. How do I mean? As we have done it today, yes. As we have done it today, you just close